Okay, they're up. Share screen. We good?
All right. So if we are all ready to go, I will count us down from 3. Sound good? Alan? Yeah. Yeah. Yes.
The cold water. Okay, we're good.
I'll count us down from 3, go to the speech, and then hand it off to you guys.
Thank you so much, Kevin.
All right. 3, 2, 1, and we're live. Good morning, everybody. My name is Tim from the State Society, and I would like to talk to you about participation codes. Throughout today's session, you will see 4 participation codes across the top of your screen. It will be a black banner with white text at the top of the screen that says Participation Code 1, followed by the 1-letter code. Participation Code 2, followed by a different 1-letter code, etc. Please write the participation codes down as you see them and put them in a safe place. At the end of the course today, you will be given a quiz, and the answers to the quiz are these participation codes. Also, be sure that you are in full screen mode and are able to see the top of the screen. We do not have access to these codes, so if you miss one, you will not be able to receive full credit for this course. Please take a minute to review the instructions for the participation codes that is located in the materials folder. If you have any questions regarding technical support, please contact the tech support chat for assistance. Also, we would like you to complete the evaluation for the instructors. It only takes a few minutes, and it really helps us create a better course. I now hand it off to Alan Gassman and Brandon Ketron.
Thank you very much, Keenan. It's a pleasure to work with you and with the New York Society. This is a bear of a subject, a real challenge for CPAs. So being that we're from Florida, I brought my Florida alligator, and my Florida alligator is going to help me show you the way to survival in this environment. We have a lot of information for you. I wanted to mention, if you are not a contributor to the Moynihan Scholarship Fund, which is sponsored by your organization, I will match your donation. So if you or anyone you know wants to donate $25 to that fund, just send me an email, let me know you did, and I will match the foundation. Match that, and then hopefully that can become an annual donation for you. People need these scholarships more than ever. We're lawyers, so we have to give you a warning. What we say and do here is going to have some mistakes. This is a very confusing 5,500 pages of things that just say the word and becomes or, the comma becomes an exclamation mark. This clause went where that clause was supposed to be. There's still no red line of the whole act. So we've done our best. We've read everything we can read. We've thought everything we can thought, but there are sure to be changes. So you have to stay aware. We had new final rules that were issued January 6, 2021. When you see light green, that's not the alligator color. Those are the new final rules. There's 120 pages of them approximately. They are well written. It is not a bad read at all. They seem to have their act together. When you see purple, these are things that we don't yet have guidance on. It's from the original act. And there were very few inconsistencies between the act and the regulatory guidance that came out. I think we can skip slide 6. I'm sure everybody knows about the primary changes that were made with unemployment, doctors' fee schedules going up by 3.75%, people getting $600 each. Now, apparently, there's going to be another $1,400 as soon as the Democrats assume their positions in office. And then at the bottom of page 6, importantly, are you going to advise your clients to defer payroll taxes now through December 31st, 2021? Are they disciplined enough to put that money into a short-term bond fund, earn some interest, and have it there when they need it? If the client is intending to take a second draw PPP loan or more SBA EIDL money, then they have to attest to the fact that the money is really, really needed in the business. So if you're not deferring the payroll taxes, that is inconsistent with saying that the money is really, really needed in the business. So it's more work for you, but something that needs to perhaps be carefully considered. The PPP funding recap, what we want to show you here is there's a lot more money on the table. The first two acts were about 660,000. They didn't use it all. There's still more money left. They tack on another 284 billion. I meant billion, not thousand. So this is serious business, a lot of money for your clients and maybe for your firm if you meet the necessity requirement, depending upon your circumstances. Brandon, do you want to lead us through the key takeaways? And by the way, we're going to repeat just about everything we say at least twice. We think that's a good way to educate you and to get you used to the terminology. So if we're going a little bit too fast or you miss something, don't worry. You're going to see it come up. Also, you do have our email addresses here. And if you forward the questions to Kenan, he will forward them to us. Or if the question doesn't get answered or you need further clarification, you do have our email addresses below each page. Send Brandon the hard questions and me the easy ones. So go ahead, Brandon.
Yeah, so there's a couple of new categories of expenses that count towards your forgiveness amount. You can now include group dental, group life insurance, group disability, group vision insurance, as well as group health insurance that was always allowed to be included. Those will now all count as payroll expenses towards satisfying the 60% rule, where you have to use at least 60% of the loan amount on payroll costs. All these are going to be included as payroll costs. These expenses could also count as calculating your payroll costs for purposes of the second draw loan. So you can get an increase for these amounts, as well as borrowers that haven't yet drawn, they can include these costs in their application for determining their monthly average of payroll cost to calculate their loan amount. What we thought you could do and what we found out later that you can't is amend your initial application and include these costs as a payroll cost and get a little bit larger loan amount. We'll go through a slide on that, but the SBA issued a procedural notice yesterday that took back the ability to do that we thought you might be able to do. So we'll cover that in some more detail. As far as non-payroll costs, there are 4 new expenses that can count towards forgiveness as well. And all this is, again, retroactive as if included in the original CARES Act. So if you have an outstanding PPP loan forgiveness application and you need some more expenses, you can include these as well. They'll also count towards your forgiveness amount for the second draw loans, but they are covered operation expenditures, which are essentially operations expenditures that you spend on software, other type of expenses to help prepare for the coronavirus, such as you had to get Zoom licenses or go to my webinar licenses, get a new accounting system so you could work remotely. All that will be included. Property damage expenditures, that's damage incurred as a result of the riots that happened. If you have any of that that's unreimbursed by insurance, that can count towards forgiveness. Supplier costs, essential supplies of the business are going to count towards forgiveness to the extent that you spend money on those. And then worker protection expenditures, mask, building barriers, purchasing ultraviolet light systems and HVAC systems to help eliminate germs and other stuff from the air, that's all going to count towards forgiveness now. So we have the old cost here on the left-hand side that you could always include, and now we have the new cost on the right-hand side. Again, all this counts towards the 60% rule, where you have to spend 60% of your loan amount on payroll costs to count towards forgiveness and get full forgiveness amount. Alan, anything to add on this issue here?
I think you covered it very well.
All right. So just don't forget about this 60% rule. It's fairly easily satisfied since we have a full 24 weeks to meet this test, but you do have to spend 60% of the loan on payroll costs. If you spend less than 60% of the loan, then you're going to have a little bit that's not going to be forgiven. This can be an important factor as well when we get to talking about the employee tax retention credit. You know, you cannot count wages that count towards PPP loan forgiveness as also eligible for the retention credit. So one strategy is to maximize these non-payroll costs, the 40% amount, as much as we can. So that way we have excess wages that could qualify towards the retention credit if we do qualify for both. And we'll go through some strategies on how that's going to work in some future slides as well. Here are the new non-payroll costs and expanded definition with some examples. We won't go through these in details, but we have them here on slides for your reference. All right, some other key takeaways. Number 2 here, you can amend your original loan application to get an increase if it was due to changes in loan rules after you originally applied. So the procedural notice listed a couple of situations where that definitely applies, and it's only limited to these situations. It's partnerships, seasonal employers, or circumstance where you might have returned your initial loan amount that you're approved for or never requested to receive that amount. You can go back and amend the application to get an additional loan amount. Partnerships will describe how this applies, but it's basically if you didn't include the partner compensation in the partnership application, then you can go back and amend your original application for the first draw, include that compensation in the application, and get an additional loan amount. Seasonal employers, there was an alternative test that came out in interim final rules that might have allowed you to get a little bit larger amount based on this new test. If that applies, again, you can go back and amend that initial application. What we're not sure of is that if you just made a simple math error on the application, can you go back and amend? We don't think so. If you qualify under one of these situations and you do have a math error, you might try including the correction on the new submitted application, seeing if the lender approves that. But technically under the rules, we don't think that is going to be allowed to just simply amend for a math error. It's limited to situations contained in the SBA procedural notice that we'll cover. Number 3, you have the ability to select the end of your covered period. It can be any time between 8 and 24 weeks from the receipt of the loan. It doesn't have to be after you spend all the loan funds. It's really just any time that you select between that 8 and 24 weeks. There's going to be a simplified loan forgiveness process if you have less than $150,000 of loans. We're not sure what that's going to look like yet. There's a current simplified application out there for loans of less than $50,000 that the SBA released. They have not gave guidance on what the 150 or less application will look like, so we're still waiting on that, but it will probably be similar to what is out there now for loans less than $50,000. Salaries and wages are limited to $100,000 on an annualized basis. So if you select a covered period between 8 and 24 weeks, you take whatever your selection is. So let's say it's 12 weeks. You do 12 divided by 52, multiplied by 100,000. That's going to be your limitation that applies as far as wages that can be paid to employees. If you got an EIDL advance, that's the $1,000 per employee, $10,000 in total that you could get in advance on the EIDL loan. It's clear now that that is not taxable, and it's also not going to reduce your PPP loan forgiveness. Originally, it would reduce that loan forgiveness. Now it does not. If you've already submitted your application and reduced your loan forgiveness by the $10,000 or whatever the advance was, the SBA did issue a procedural notice saying that what they're going to do is take that $10,000 or whatever the amount was, add an interest payment to it, send it back to the lender, and then the lender will send that out to you. There's no process as far as applying to get that back. It's essentially going to happen automatically. But if you did reduce it and you don't receive it in the next couple of weeks, you might want to reach out to a lender and see what the status of that is. Okay, so number 8 here. If you were not in business prior to February 15th, 2020, you're not going to be eligible for a loan. There's some reference in the statute about new entities. What they're talking about are entities that were established between January 1 and February 15th, 2020. If you started up in the middle of the pandemic in June or July, you're not going to be eligible for any assistance through the PPP program. All the safe harbors and exceptions for the FTE headcounts, your full-time equivalent employees, and reduction of salaries that you have to maintain based on reference periods all still apply. The exceptions all still apply as if they were the same as the first round. So that's good news for borrowers. What we don't know exactly is how these are going to work for the second round, whether they're going to change any of the reference periods, whether they're going to expand on some of these exceptions. We'll have to wait and see what SBA does there. They didn't include any of that in the January 6 rules. Schedule F farmers and ranchers get a loan based upon their 2019 or 2020 Schedule F gross income rather than net income, which is a welcome sight for farmers and ranchers. Unlike Schedule C taxpayers, where it's based upon net income, we'll go through how that applies for them. 501c6 entities are now eligible as well to receive a PPP loan. You still have to meet the necessity requirement. You still have to satisfy the gross receipts test if it's for the second round. But they are eligible to receive this loan. So the act also allowed for borrowers in bankruptcy to potentially get a PPP loan, but only if the SBA issued guidance that basically implemented this to occur. The SBA has not done that and does not intend to do that as far as we know, unless the change of the administration, the new SBA director comes in and decides to allow borrowers in bankruptcy to go ahead and get PPP loans. So that's another one where we have to just wait and see what happens with a change in the administration. Okay, the employee tax retention credit, the ability to get a payroll tax credit based upon wages that you pay to your employees during 2020 or 2021 now applies even if you got a PPP loan. Originally, it was one or the other. You could only get a PPP or you could only claim the retention credit. Now you can do both, and now you can do it retroactively. The only catch is if you include wages that count towards forgiveness, they also don't count towards the credit. So there's some analysis that needs to be done there to try to maximize both. And we'll go through that in some detail as well. All right, slide 22, second draw loan rules. So a little bit different than the first draw. You have to have less than 300 employees, and then you also have to satisfy the second test of a 25% or more drop in gross receipts comparing calendar quarters to the same quarter of the previous year. The loan still has to be necessary. Don't forget about the necessity requirement. Even if you meet the gross receipts drop, you still have to analyze, is this loan necessary to support the ongoing operations of the business? We'll go through some slides on that necessity requirement shortly. But you do this, you're looking at quarter of 2020 compared to the same quarter in 2019. So Q1 2020 to Q1 of 2019, Q2 to Q2, Q3 to Q3, Q4 to Q4. You can't mix and match here. It has to be the same quarter of the previous year. Now, there's an alternative test under the January 6 interim final rules that allow you to compare the entire 2020 calendar year to the entire 2019 calendar year. If you meet it for the entire year, a 25% or more dropped, then they say mathematically you were almost guaranteed to have a quarter that drops. So we're going to allow that to happen. And it's a lot easier on borrowers to just submit a tax return showing the 2020 receipts and showing the 2019 receipts rather than having to do a quarter by quarter analysis. If you were not in business in 2019, there's some alternatives that apply here as far as testing. We'll go through what those are. Good news for restaurants, hotels, motels, and other food and lodging businesses with an NAICS code of 72. If you qualify under that NAICS code and you qualify for a second draw loan, you can get 3.5 times your average monthly payroll instead of the 2.5 times that counts for other borrowers. Now, as far as how do you calculate the second draw loan, again, it's your average monthly payroll cost, but we have 3 different periods to look at as far as determining our average monthly. You can use 2019 calendar year, the 2020 calendar year, or the 12 months immediately preceding the date of the loan. So if you apply today on January 15th, you can look back at January 14th, 2020, all the way back to 2021, all the way back to January 14th of 2020, and compute the average based upon those dates. We have until March 31st to apply. You also, if you're getting a second draw loan, you have to certify that you've used the entire first round loan amount before you receive the second draw amount. Now you can go ahead and apply for the second draw without having used all the first, but before that second draw can hit your bank account, all the first draw loan has to be spent and used on permitted expenses in order to qualify. Again, we want to make sure we understand the interaction with the wage credit. We'll discuss that in some detail. Okay, so Alan, you want to go over these deadlines or want me to keep going here?
Yeah, you keep going. You're doing great.
Okay. So some important deadlines to keep in mind. First one, the PPP application window is going to open up to all borrowers and banks on the 19th. It's currently open today at small community banks and other small lenders. If you have a relationship with one of those banks, you might be able to get a client in earlier, but January 19th for all borrowers. February 15th is another important date, is the date that applies to report the use of funds for medical practices that got provider relief payments. There's reporting requirements that apply. Make sure you don't miss these deadlines. Make sure we're reporting all the stuff that needs to be reported accurately. March 31st is when the PPP window closes. So again, this is all first come, first serve, just like the first round. So we don't want to wait to this deadline because it's likely that all of the funds will be used up. So keep these dates in mind, apply sooner rather than later. This March 31st is also the deadline to amend your initial application to include any increase for certain circumstances. June 30th is the end of the quarter for the employee retention credits. It applies for only the first and second quarter. The payroll tax return for that second quarter is due at the end of July. So that would be your deadline to claim the retention credit. And that's also the same deadline for those who have a little bit of the provider relief funds that were spent in 2021 and weren't all spent in 2020. Or if you get I guess this is now fourth round of provider relief funds as a result of the allocation in the new Economic Aid Act, you might have some reporting that's due in July 31st as well. July 31st, another date that's important, same date as the deadline to file your payroll tax return, is probably also going to be the deadline to request an advance on your employee retention credits if you would like to request it with the Form 7200. You can get an advance on these credits. You can apply now to get this advance, and it's based upon your quarterly wages from 2019. And then you reconcile this on your actual payroll tax return. We'll talk a little bit more about that as well in some future slides. And then finally, 10 months after the end of your covered period is the date that you have to submit your forgiveness application. If you don't submit it by this date, you're going to be paying interest on the loan. The interest is no longer going to be deferred. If you can submit after this date, it's just you have to start paying the interest amount. So keep this 10-month dates in mind. We want to make sure we're not causing any interest payments when that can be due when we have to avoid them. Okay, Alan, you want to talk a little bit and introduce us to the EIDL loan changes and the shuttered venue grants?
Sure. So the EIDL program, let's remember, it started out, to our knowledge, to everyone's knowledge, to be that quick $10,000 hit. Just fill out this application online and you'll get $10,000 within 3 days. No one on the face of the earth got the 10,000 within the 3 days, but 3 to 4 weeks later, people were getting up to 1,000 per employee, up to $10,000 total. It's interesting that you had to say on the application that you had substantial issues requiring the EIDL loan, and that the definitions and the regulations of the EIDL rules say that substantial means really big problem. It doesn't mean, well, I lost a little bit, or I need this because things are more uncertain. You had to have substantial drop in income or substantially higher expenses. But of course, none of us had that. We just got the money anyway. We didn't know. Now, that $10,000 or less came to you, we now know, income tax free. And while we were all told, and the original CARES Act said that the 10,000 would cause part of your PPP loan to be repayable, that did not happen. The new act clearly says that your PPP loan is not reduced by your EIDL grant, and that your EIDL grant is not subject to income taxes. Now, many borrowers went to the SBA and got a lot of money as loans under the EIDL program. And those loans are bearing interest at 3.75%. They're not tax-free because they're not forgiven. The interest paid on them will be deductible as interest. But the government is not a gentle creditor. So please keep in mind these EIDL loans, they seem soft and fuzzy, and they have 30-year amortizations for businesses that typically last 5 or 6 years. And when these businesses end up in bankruptcy, the government is going to be looking at these bankrupt debtors, and they're going to be wondering if they followed the EIDL rules. And a couple of the EIDL rules that you see here under number 3 is you can't pay bonuses to employees while you have an EIDL loan in place. That would include distributions to S corporation owners. And this would cause significant issues. Now, the loan agreements say that you can get written permission from the SBA to pay bonuses and to make distributions. And the SBA has been pretty generous in giving emails to borrowers saying, yes, if it is in the normal course of business, whatever that means, you can do these things. The new act indicates that certain PPP borrowers will be able to convert their EIDL loans into PPP loans and get them forgiven. But there is nothing beyond what I just said as far as what they're intending, who's going to qualify, how that's going to work, etc. The new EIDL program under this act was only replenished with $20 billion. Now, $20 billion is a lot of money. I agree, but it's not like $280 billion. And it's going to be mainly for borrowers who are in low income geographical areas. So there's no guidance on that. Another 15 billion was set aside for what they call shuttered venue grants. And this is not only for theaters and movie houses and entertainment facilities that have had a 25% or greater reduction in revenue. It's also for a lot of the professional groups who go there, like performing groups, agencies that provide performers, and things like that. We'll go into that in more detail, but it's a very juicy loan because it's 40% of 2019 gross revenue. That's a big amount when you take into account that the profit margin for a lot of these venues, especially theaters, is a very low profit margin. They sell $1 million worth of tickets. They pay the talent and the unions and everybody else $950,000. They're left with $50,000 of profits, mostly from food and popcorn. So for now, for them to get, if they have 20 of those shows a year, that's 20 million, 40% of 20 million. That's a huge amount of money. And they can only use it being paid forward. So that's information on the EIDL program. One last thing I'll mention. If you are an individual EIDL borrower and you borrow over a certain amount, they are supposed to put a UCC-1 financing statement lien against your personal assets. According to the recent 11th Circuit Court of Opinion case, the lien put on someone's IRA disqualifies the IRA from creditor protection. And according to the tax court laws, in the Daly case, when you put a lien against your IRA and it's secured by real debt that exists, you've disqualified your IRA. So there's going to be a lot of EIDL borrowers with disqualified IRAs, creditor exemption, and all sorts of issues. Be careful in the world of EIDL. Page 25, you've got to decide what your strategy is as a CPA or a CPA firm. You're here today trying your best to understand the rules, and we've provided everything we can here as far as the slides are concerned. You can read the regulations. You cannot read the new act. It's not practical to read 5,500 pages. Number 2, apply for everything a borrower may receive, assuming that they that they meet the necessity requirement, that they meet the substantiality requirement under EIDL. Number 3, are you going to wait to understand everything before you apply? Hopefully not. The lesson with the original PPP borrowers, for the most part, was that the early birds got the worms. Remember, every time the SBA issued more regulations, they were mostly taxpayer unfriendly. So when in doubt, fill it out. But we also have the PPP agency rules. And we have been thinking that this applies to mortgage brokers. The original law that you have here, what is an agent? An agent is an authorized representative, including an attorney, accountant, consultant, packager, loan service provider, or other person. And then it says representing the applicant by conducting business with the SBA. Well, if you're a CPA filling out this form and helping your client understand it, I don't see that you are conducting business with the SBA. But then you go to the definition. What does it mean conducting business with the SBA? And there under B1, it says preparing or submitting on behalf of an applicant an application for financial assistance of any kind, assistance from the investment division of the SBA, or assistance in procurement and technical matters, or preparing or processing on behalf of a lender an application for the financial assistance. So suddenly, CPAs throughout the country become agents under this statute. And the statute, as it was originally enacted, said that only the lender could pay an agency fee if it wanted to, and not more than 1% on the first 350,000. So when you read this statute literally, the CPA or the CPA firm or the lawyer, you could spend $3,000 worth of time helping somebody get a $50,000 loan. 1% of $50,000 is $500, isn't it? So you can't charge your $3,000 worth of time, and you weren't supposed to be paid by the client in the first place. Well, at least the new act here on page 28 says in the underlined section, such fees shall be paid by the eligible recipient and may not be paid out of the proceeds of a covered loan. So now I think the question is, you can do this, and this was fortunately retroactive. I think the only question is, do you have to notify your clients that you charge them more than what you were allowed to charge them and offer them the difference back, or are you going to wait to see which clients might ask for it? If you've got good relationships with your clients, I don't think they're going to ask you for it. But Brandon, what are your thoughts on this?
Yeah, I think it's an interesting question, and it seems to me a little bit unreasonable for such a low fee to be paid to the agents with a very complicated application that requires a lot of documentation that most clients reach out to their CPAs to provide and spend a lot of time on this, and probably deserve a reasonable fee for that time. So I think the question is, like Alan said, are you reaching out to clients to return the excess here? Are you worrying about this at all? But just keep in mind that it is out there, and that you could get in a dispute with a client because you might have overcharged them for certain situations.
Okay, so these next pages are pages that you probably are going to want to read. We're not going to go over everything here, but this is our summary of those January 6th IFRs. So Brandon, do you want to tell us what you think is important here, or what maybe we won't cover elsewhere?
Yeah, so we bolded the important items here that stand out from the January 6 rules. I think we have about 50 bullet points, but we'll just go through the bold ones to touch base on the important ones. Number one, they do allow some flexibility to let you use a 2019 or 2020 Schedule F or Schedule C to calculate the loan amount. It's not just 2019 like applied for the first round. You have that flexibility to also use 2020 as well. If you are a business that permanently closed, you're no longer eligible to receive a PPP loan. So keep that in mind. Don't apply when you don't have any expectation to open up a business. Number one, you're not going to be able to spend the funds and you'd have to repay it anyway. And number two, you're not considered to be eligible because you have no ongoing operations. So is the loan? The loan is not necessary. If you are closed down and intend to reopen, then that's okay. You can still apply as long as you have that intention of reopening and having an ongoing business.
Brandon, before we go further, can you go back? Yep. I want to make sure that we're clear on something because I'm not even clear on it. Let's say you're a 501c6 organization, a chamber of commerce. Your volume's way down because people haven't been paying their dues, and advertising's lower than what it was. So you want to apply for the PPP loan. You weren't able to before, but now you can. Are you allowed to get a first draft loan now and a second draft loan now? Or how is that going to work?
Yeah, so I think you can get both, but you can't get them at the same time. Because remember, in order to be eligible for the second one, you had to at first spend the first one. So you can get your first round loan, spend it as quick as possible, and then apply it as once you spent it all, apply for the second round, assuming that you meet the 25% reduction test. That doesn't apply for the first. The 25% only applies for the second round. But the question really is, are we going to be able to spend all the first one in time to get a second one before they run out of funds? That's where we're at on that.
Okay, now what if you could have qualified for the first one, but you didn't know?
Mm-hmm.
So you didn't apply. Is it too late to get a first?
No, you can go ahead and get the first now. You apply. You don't have to show a 25% reduction in gross receipts. All you have to do is prove that the loan is necessary. Same requirements that applied for the original first round draw.
So the previous July 31st deadline is no longer a deadline?
Right. Yeah, it's extended out to March 31st.
Then the question is whether you had necessity at the time that you apply for it now?
Right.
Okay.
Right.
And then you can apply for your second one when you spend your first one if there's any money left at that time.
Right.
Okay. Thanks for your patience.
Sure. Yeah, that's good questions though, because that is a point of confusion. So we have fielded a lot of questions on that particular issue. Okay, so if you have a loan of $150,000 or less, again, there's going to be the simplified application, and then there's also a simplified process for actually applying for the actual loan. You don't have to submit as much documentation with your loan application. You don't have to submit documentation of your gross receipts dropping more than 25%. You can just certify that you did meet that 25% test. Now, if you do that, you still have to submit documentation that you had your drop in 25% before you apply for forgiveness or include it with your forgiveness application. So don't just certify assuming that you've met the test, and then later, once you start pulling your documentation, you realize that you haven't, because then you're going to run into trouble with not being able to get the loan forgiven. So I would suggest to go ahead and submit this documentation with the application just so we know we do qualify and it's certain that we have it. Partners in a partnership, you can include your partner compensation in the loan application, and that compensation is based upon your 2019 or 2020 net earnings from self-employment reported on the K-1. You have to reduce it by 179 expenses, unreimbursed partnership expenses, and oil and gas depletion, and then you multiply it by 0.9235, which is basically intended to remove the employee's share of self-employment taxes so it matches up with more akin to a salary paid to partners. Another important point here, if you have a corporate group, so that's a bunch of subsidiaries owned directly by one common parent, or people that have related party affiliated companies, you can only get a cap of $20 million in total for your first draw. So if you have 10 subsidiaries, across those 10 subsidiaries, only 20 million in total. That applies for the first draw. It's 4 million for the second draw. We have some slides on this in some future to talk about, but the important thing to point out here is that it's on the borrower to certify that they're not exceeding this amount. The lender is not going to know, and the lender is going to go ahead and issue that loan because they have no responsibility. But if you get $1 over 20 million, it disqualifies you from loan forgiveness, and every loan would have to be repaid. So keep this in mind. Make sure we're not exceeding this for large corporate groups. We mentioned Schedule C. You can use 2019 or 2020 to calculate your loan amount. If you were a farmer or rancher, Schedule F, it's your line 9 gross income to calculate the loan amount. And again, that's 2019 or 2020. Notice the difference here between net profit for Schedule C, gross income for farmers. So that was an interesting, we thought it might have been a typo, but turns out the January 6 rules did confirm that this was the case. All right, next one, the alternative covered period is no more. So you only have a date between 8 and 24 weeks after receipt of your loan to select your covered period. You can't start the covered period on the start date of a payroll period like you could originally. That is no longer the case. The alternative covered period is eliminated. We talked about the EIDL not being deducted any longer. We talked about the ability to submit tax returns showing a full calendar year 2020 and a full calendar year 2019 compared to each other to certify that you had a drop of gross receipts. If you do meet that test, it's just submitting your annual tax returns rather than quarterly financial statements or something similar to prove the quarter. Gross receipts for purpose of calculating that 25% test do not include your PPP loan forgiveness. That's not considered to be a receipt. But other CARES Act grants, maybe those HHS provider relief funds, we think those are considered to be gross receipts. They're also going to be taxable. We'll talk about that in some future slides, but those are gross receipts. You have to include that for purposes of analyzing whether you had a 25% or more reduction of your gross receipts. Single corporate groups limited to 4 million in total for the second draw. If you apply at the same lender, then you don't have to submit any documentation to that lender as far as substantiating payroll cost if you're using the same figures that you use to calculate your initial loan. So simplified process for borrowers is you go back to the same bank, say I want the same loan amount as I had the first time. As long as you certify that you met the 25% and the loan is necessary, then that loan's going to be approved for the exact same amount. As far as determining gross receipts and how do we calculate this, whether it's cash or accrual, it's based upon the entity's accounting method that's used for tax purposes. So if they're a cash basis taxpayer, cash method of accounting applies. If they're accrual basis taxpayer, accrual method of accounting applies. Nonprofits, we do have a definition of gross receipts. We have that in some future slides, so we'll go over what that definition is. We've mentioned this probably ad nauseum, but we're going to keep mentioning it because it is important. Don't forget about the necessity standard. Just because you have a 25% reduction does not mean that the loan is necessary. If you have plenty of cash on hand in the business to get through the next year, and then the loan's likely not going to be necessary, even if you have a drop in gross receipts. So don't forget about this. You're also required to certify that if you do get an increase in your loan, that certification as far as necessity relates back to the original loan application. So it's not a recertification, but keep in mind that you have to use up that amount or have eligible expenses that use that increase amount in order to be eligible for the second draw loan rules. We have the sample application here that the SBA came out with. Most borrowers or lenders are going to have an online portal to fill out, but this is something that you can get started with as far as filling out, understanding what questions and certifications that you have to make on the application. Again, the necessity requirement still remains. We have it circled here on slide 39. So this is the application and instructions that apply for the second draw. All right, so the ability to amend your application, we've touched on this, but there's 6 circumstances where this can apply. And what we're talking about here is the ability to take your first draw application. Let's say you got $1 million of a loan amount. You can go back and amend that initial application to include certain costs and increase that to what you should have gotten in the first place, but couldn't get because the rules changed on you and you applied before those rule changes. So what changes are we talking about? We're talking about number 1, partnerships that may not have included partners' compensation in the original loan amount. You can include the net earnings from self-employment of the partner in the loan application as a payroll cost. If you didn't do that originally, you can now go back and amend that original application to request the additional amount. Seasonal employers, there's alternative tests that applied. You can use a 12-week period selected for determining your average monthly payroll cost. Originally, there were some different dates that applied there, so you might have a 12-week period now that allows for an increase. Again, you can go back and amend the application. Farmers and ranchers, guidance originally published by the SBA said this was based upon net income, just like it would for Schedule C taxpayers. Now we know it's based upon gross income. So if you applied initially using net, now you can go back and amend to use the gross amount. three other situations. If you got a PPP loan and you repaid that loan prior to December 27th, you can go back and request to have that initial loan back now. Maybe you thought you didn't meet the necessity requirement, so you return the loan. Now it's pretty clear that you do, and you can submit an application for that initial loan back, spend it, and then apply for the second round. If you return just a portion of your loan, you can request that portion back. And then if you got approved for a $2 million loan, but you said you only need $1 million, but now the other $1 million is needed and necessary, you can request that another initial $1 million back by submitting an amended application. March 31st is the deadline to apply for these increases. The SBA is not yet accepting applications for loan increases. I think it's going to sometime around the week of the 20th is when they are going to open this up for submitting increases of your loan amount, according to this SBA procedural notice that was published yesterday. So keep in mind, start doing this analysis, and that way we can go ahead and apply whenever we're ready. We have guidance. Go ahead, Alan. Yep.
Why not tips?
Yeah, that was an interesting one. Tips were always included in the original CARES Act. It just wasn't entirely clear how we consider that as payroll costs, whether it had to be, if tips paid by customers, even if it wasn't out of the employer's pocket, counted. And rules came out that made it clear that they did. So we thought that, okay, maybe people didn't include those originally. Now that the rules made it clear that tips are included, that this could be another circumstance where we could amend that application. Turns out that they didn't include that. So unfortunately, tips aren't going to be allowed to go back and amend the application to include. The other one we thought might happen was the group benefits, the health, dental, vision, life. If you didn't include those initially, we thought you could go back and include them now. Apparently, SBA did not agree with that and said that you can't do it. It's only limited to the 6 circumstances we talked about.
Okay. So just to show you, you can go back here, but we have some nice slides that explain the seasonal employer situation and the partnership situation. So we're not going to go over them. We're just showing you that they're here. And we try to design our slides to make them sort of like outlines so that you can read our slides and understand what an outline would tell you. So one of the biggest questions we get is, when will the forgiveness application for under $150,000 come out? And the answer is, we don't have any idea, but it seems like it should come out soon. Since it's just going to be one page. It should look a lot like the $50,000 abbreviated application, shouldn't it?
Yeah, that's what we think. And then they may just simply modify the instructions for that and say it's 150. If they do that, it would be the case where it doesn't matter about your employee headcount, your salary reductions, or anything related to those certifications. It's just, did you use the loan? Yes. If you did, you certify that you spend it on the right things and your loan's forgiven. We'll see if they go that far with it or if it's something in between.
But that doesn't, we don't think that this means that you don't get or that you would get a reduction if you did not keep enough full-time employees on the payroll. For the $50,000 exception, all you have to do is say you would try it in good faith to keep the right employees on the payroll. You tried in good faith not to reduce anyone's compensation by more than 25%. But if you in fact did that, you still get full forgiveness if your loan is under 50,000. We don't think that's going to happen with the 150. We think the application is going to be easier to file, but is there any indication that they're going to not pay attention to the reduced FTE or reduced compensation rules?
Yeah, no, I think that there's a possibility that they might increase that 50,000 really, I guess, safe harbor for reduction up to the 150. They haven't done it yet, but there is rumor that might be the case. We'll just have to wait and see what happens.
Yeah, that may well be what we are looking for here. So what a taxicoaster we've been through with this, especially those of you who had to do year-end tax planning, not knowing whether the expenses for the PPP loan would be deductible. So what happened here was when the CARES Act passed March 27, 2020, it clearly said that there would be no tax on the forgiveness of the PPP loan. So everybody decided, great news. I get the money, I pay it for my employees, and I don't pay tax on it. Well, the IRS then issued Notice 2020-32 in April and said, wait a minute, under Internal Revenue Code Section 265 and the tax benefit rule, if you pay no tax on the loan, then you cannot deduct the expenses. And this caused a lot of surprise, especially by Senators Grassley, Wyden, and Neal. When it includes the chairman of the Ways and Means Committee and the Senate Finance Committee, you know there's some confusion going on. They said, no, we did not intend to deny anyone a tax deduction. So I guess the people who drafted the bill weren't aware of Section 265 and the tax benefit rule, or hadn't thought about it. So the IRS maintained that stance, and we did a lot of research, and we felt that there was a substantial authority that you would be able to write off the expenses, but certainly that issue was out there, and it was going to be a big snake of an issue. And in fact, in November, the IRS released Revenue Ruling 2020-27, and they said, hey, not only do you not get the expenses, but you can't deduct them in 2020. Even though the loan wouldn't be forgiven by then, you were substantially certain that the loan will be forgiven. So therefore, the expenses will not be tax deductible. Well, fortunately, along comes Congress and the president, and we have these rules, and this is directly out of the law. It was pretty short and sweet. A, no deduction will be denied or reduced. So we still have the prior law, which says that having the loan forgiven is not income. Now we have the new law, which says the deduction will not be denied or reduced. And then they went even further to try to make sure that Section 108 or equitable tax rules would not apply to require any tax attribute to be reduced, such as having to reduce the basis of depreciable property or having to reduce net operating losses. And then they even went a little farther and said no basis increase will be denied. So let's take the example of, I have an S corporation and it has zero revenue for 2020, except for $1 million PPP loan. And I used that $1 million to pay $1 million worth of operating expenses, including payroll. Now, my basis in the stock, let's say, was zero in the beginning of the year. I get the $1 million loan. At the end of the year, the loan has not been forgiven. Brandon, what is the basis of my S corporation stock?
Yeah, so what we think is the result is you're really using the Revenue Ruling 2020-27 against the IRS here and saying, since you have a reasonable expectation of loan forgiveness, that you're deemed to have the forgiveness occur, so you get $1 million increase in basis as a result of the recognition of tax exempt income of $1 million, which would allow those $1 million of expenses to flow through and be deducted against other income at the shareholder level. There is one question, if is that correct? Is that the correct analysis? Well, it's very clear that the forgiveness is tax exempt income that increases basis. So when it's actually forgiven, it's certain the basis steps up. But I think you have authority to say that step up occurred in 2020 because of the reasonable expectation of loan forgiveness that would allow the deduction to occur. So we have some slides on that goes through it. Alan, anything you wanted to add?
The basis goes up under the loan because of the Gillets case, which is a U.S. Supreme Court case. So that's pretty firm law. At Section 108, under the discharge of indebtedness rules, if you have a Section 108 discharge of exclusion from discharge of indebtedness, you reduce tax attributes. So Congress made sure that you would not have to reduce your tax attributes here. So in my example, then, Brandon, I have a $1 million net operating loss that I can carry back and get immediate cash.
Yep.
Even though I didn't lose a dollar. I got $1 million, I spent $1 million, could have included my own salary. So that is too good to be true, and we'll take it. But I think we have to warn clients that if the IRS audits them and says, wait, your loan was not sure to be forgiven, there were some issues there, and therefore you didn't get the basis, so you can't deduct those expenses. You've got to wait till next year to get the expenses deducted when the loan is actually forgiven.
Yeah, and I think that might be a bigger issue for loans greater than $2 million, where you have to worry about necessity even more, filling out the necessity questionnaire. I think that's definitely an issue for those larger loans. For less than 2 million, where we have the safe harbor, where it's probably not going to be audited for necessity, maybe though, a little bit of a less of an issue.
Yeah, I mean, I know for a fact that there were many borrowers who are in the medical marijuana business, and that's illegal under federal law, so they shouldn't have gotten those loans. I know that there's a lot of borrowers in the, I'll call it dance club business, strip bar business. They were not supposed to get those loans. They did get the loans, so they're not supposed to get forgiveness. So if they get audited, it's going to be interesting. But I think all a CPA can do really is tell your client what the situation is and make sure there's substantial authority for the position you're taking. Now, speaking of income tax, how does the employee retention credit, when I get money from Uncle Sam to reimburse me for wages paid to my employees, how is that taxed?
Yeah, so it's not taxable. It's just like PPP loan forgiveness prior to the new act. It's not taxable, but to the extent you got the credit against those wages aren't going to be deductible. So in a roundabout kind of way, it is almost subject to tax, but it is a deduction disallowance rather than actual receipt of income upon receipt of the credit.
Okay. And then the HHS program, where doctors and other medical providers got a lot of money deposited into their accounts. Remember, it was interesting because they didn't know what was coming, and suddenly they got 1.9% of their 2019 Medicare receipts, and then later on they got more. That is all going to be taxable if they can keep it, and I assume non-taxable to the extent they have to pay it back because they didn't have enough expenses and loss of receipts, right?
Yep, that's the result. You're a tax exempt healthcare provider too. It's not obviously tax exempt income as long as it's not subject to any type of unrelated trade or business income rules that would apply.
Right. We do have section 139 here. You can read it. There's a really good Forbes blog on it written by Tony Nitti, where an employer can deduct reasonable and necessary expenses paid to an employee to reimburse them for family, living, and related expenses incurred as the result of the virus. So that could include babysitting, special software for your children, taking your children on a trip that they needed to go on. And then number two, expenses for the rehabilitation or repair of a personal residence or replacement of contents because of the disaster. So that could include these air conditioning systems, which ultraviolet lights in the air conditioning filters, and building out vinyl parts in your house so that you can't listen to your mother-in-law or your father-in-law, no matter how loud they are, to keep them germ-free. Things like that. That's just an aside that we thought we would share with you. So there is case law on when a loan would be considered to be forgiven. It's a May 28, 2020 case that is a pretty good read on getting to the decision that the loan was considered to be forgiven in 2020, even if you had not filed the application. The basis rules are not as challenging in the partnership arena. Brandon, there's been people talking about the at-risk rules. What I remember about the at-risk rules from when I got my LLM in taxation was that they were complicated. What does this boil down to for us?
Yeah, so the issue is that the PPP loan being non-recourse, with no personal guarantees, generally would not be considered an at-risk amount. But I think what we get to is there is a proposed regulation that was issued in 1979 that you say you get an at-risk increase for the taxpayer's share of tax-exempt receipts from the activity. So we think the PPP loan forgiveness as tax-exempt income would increase the at-risk amount, so it eliminates this potential issue. There's decent articles on the at-risk rules and how they interact, and these proposed regs were never finalized, but generally are relied upon by taxpayers. So we think you're okay here. It also, for partnerships, undistributed partnership income reported by a partner increases the amount at risk. Again, that tax exempt income should be undistributed to the partner and increase the at-risk amount.
Okay, what about the great state of New York and how they are going to address these issues?
Yeah, so we were concerned initially, I think when we gave this presentation a few weeks back, that New York State had decoupled from the federal tax treatment of most of the CARES Act provisions. I think it was effective as of March sometime of 2020, which was when the CARES Act was passed. Good news is they just recently issued some guidance on whether they were going to follow the federal law or decouple. So these FAQs address that. The stimulus payments are tax-free. You still have your waiver of RMDs, required minimum distributions for 2020. You still are allowed to defer out the income from retirement benefits over a 3-year period is another issue. Most importantly, though, loans forgiven are excluded from New York adjusted gross income. Originally, this was going to be included, but now they've stepped back from that position. New York State is not going to tax the loan forgiveness. They're also going to allow you to deduct the expenses. One important rule that they are not following for as far as differences between federal and state is the ability to carry back NOLs. They have decoupled from the tax treatment of the CARES Act changes to the net operating losses, so no carrybacks allowed for New York State tax purposes. There's also, they didn't agree with the changes to the qualified improvement property, which essentially the real benefit of this is a qualified improvement property gets a 15-year life and allowed to be depreciated using bonus depreciation. Well, for New York State tax purposes, that's not going to apply, not going to be eligible for bonus depreciation. So it's another adjustment that would have to be made on, I think, this Form IT 558 to show the changes between federal and state tax law changes. So keep those in mind when you're filling out returns for the next couple of years as far as differences between CARES Act changes, federal purposes and state law purposes.
Okay, so I think we've covered the second draw PPP program pretty well. What should we add? I think the definition of gross receipts is certainly something to review, but let's look again before we go. If you want a second draw loan, number one, you have to meet the necessity requirement at the time of the application. Number two, no more than 300 employees. Number three, has or will use the full amount of their first PPP loan before they get the second one. And then number four, you've got the 25% gross receipts reduction. So Brandon, what would you add here for page 84?
Yeah, just the ability from the January 6th interim final rules to use the 2019 versus 2020 full calendar year to do that 25% reduction test. The wrong rules make it clear, the interim final rules make it clear that you had to have used that entire first draw amount before you receive the second draw amount. And then there's some exceptions to this 300 employee rule. If you're a restaurant, it's just per location. If you're a news organization, again, it's 300 employees per location, not necessarily 300 employees in total. As far as testing, if you're not in business for the entire 2019 year, if you were just in business in the third or fourth quarter, then you can use all of 2020 quarters compared back to that third or the fourth quarter. So some different alternatives there. If you're only in business in the fourth quarter of 2019, then we're comparing all 4 quarters of 2020 to that fourth quarter of 2019 to see if we qualify. And then if you're only open for the first couple of months of 2020, then we compare our receipts for the second, third, or fourth quarter to the first quarter of 2020. So those are the alternatives that do apply there. So what's considered to be a gross receipt? Generally anything and everything. There are a few exceptions, but anything that you receive in the business, regardless of whether it's actually related to the business or not. This includes investment accounts, dividends, interest on those accounts. All that's going to be considered a gross receipt. You can reduce receipts by returns and allowances. That's okay. It's interesting that they pointed out specifically that if you're a contractor and you make a purchase and then get reimbursed by that from the customer, that reimbursement payment is going to be considered a receipt that would increase your gross receipts. Investment income, we mentioned, cannot be excluded. Payroll taxes are not going to be excluded. You can exclude from gross receipts these three amounts. One, taxes, such as sales taxes, where you just collect those and immediately send them back to the taxing authority. That's not going to be considered a gross receipt. Intercompany transactions, as far as receipts from a related party or a related company, that's not going to be considered a gross receipt. And then if you are a travel agent, a real estate agent, an advertising agent, conference manager, freight forwarder, or a customs broker, and you collect an amount that you're supposed to send to another party, so I guess a travel agency collecting a hotel, whatever the room's going to be, and then sending it directly to the hotel, that's not going to be considered a gross receipt to the travel agency, just the receipt that they actually receive for brokering the transaction as far as included for them.
Brandon, is there a boat going by your office or a printer or something?
I think there's somebody on the roof nailing some stuff in. It's very loud.
We apologize for that.
I'm going to mute myself until this happens. I'll let you go forward.
Okay. Why don't you buzz our office manager and ask her to have them stop? I do apologize to everybody. Okay, the calculation of gross receipts of affiliates rule you have here on page 88 so that you know it's there if you have multiple clients and you're looking at this. As we said, the maximum loan you can get for a single corporate group is 20 million combined old and new PPP loans, and the maximum cap for a corporate group for second draw loans is $40 million. Now, what is a corporate group? The definition here, for purposes of this limit, businesses are part of a single corporate group if they are majority owned directly or indirectly by a common parent. So the way I read that, if my client has a company that owns 51% of 10 other companies, then they are considered a single corporate group. But if my client owns 26% of 20 different companies and his best friend owns 26%, even though together they own 50%, I don't think that they would be a single corporate group. I hope we'll get more guidance on this because we've had phone calls about it and it's a big deal to a lot of big companies, but that's what we know. There's no definitions elsewhere that we've been able to find that would apply to this. Now, the gross receipts of a tax exempt or not-for-profit organization for purposes of this 25% rule is very similar to what you would think it would be. It does include gifts, contributions, grants, and similar amounts. And most charities have suffered a significant reduction in donations and in operating income. So there is the list for you. Just to nail this down, to make it very clear, it's now in the statute. We don't have to rely on the regulations. Once you get the PPP loan, you have anywhere between 8 and 24 weeks to declare your covered period. Now, I think most borrowers and their CPAs have intended that the covered period will end the day that enough wages have been paid to allow for full forgiveness. But now, because if you use, to the extent you use wages towards your PPP loan forgiveness, you cannot use them towards the wage credit. So more borrowers are going to go the full 24 months in order to maximize the wage credit. And if you're going to file this application before you have investigated the wage credit, I think quite honestly, you're ill-advised. You cannot file this application until you have thought about the the wage credit. Page 92, there's a famous New Yorker and the lyrics to the song, The Bare Necessities. So the best way to look at the necessity test, in our opinion, is to take a look at Internal Revenue Code Section 531, the accumulated earnings tax. There's a lot of case law, and if you can justify that you need the money and the accumulated earnings tax would not apply, then I think you've got a shot at this. Please keep in mind that this could be a federal crime to borrow money that is not necessary. So you want to be very careful and don't put things in writing. There's no federal CPA client evidence rule. The confidentiality is between a lawyer and a client. So if you can get a lawyer to hire you to look at this, that may work, or a lawyer to hire another CPA firm to look at it, because you can't trust lawyers to look at anything. I know that. But looking at this, I think it's a shock to a lot of people, and you have to be careful with it. Even though the SBA has said if it's under 2 million, they're not going to look at it. They're going to assume the loan was necessary. That is not going to be binding on other federal agencies, including your friendly FBI and Attorney General, and your neighbor who sees you got the loan, knows the amount from looking at the website, and files a whistleblower action against you. So you do have to be careful. The application for over $2 million borrowers is here at page 15. You can see all the different factors. They've carefully thought this through before you go forward with that. Brandon, how's the sound situation over where you are?
Yeah, we should be better now. I think they're going to take a little lunch break and then come back later.
Yeah, they could fill out their PPP loan forgiveness application. Everybody needs time to do that. Brandon, we've got 27 minutes left here. So I definitely want to cover the earned wage credit. What I will say is there's always a lot of questions. If you are a Schedule C or Schedule F taxpayer and got the loan and you didn't pay any wages to anybody, then when you get the loan, it's automatically forgiven. And you don't really need to worry about what you do with the loan proceeds. There's some exceptions for fishing boat owners that may apply here. But generally, you get the loan based on your Schedule C net income, and the loan is considered to be forgiven when you get it. So the wage credit is, where is the wage credit?
I think we start on slide 223.
Yep. So I'll take you to 223. By the way, did you have to climb on the roof to get them up?
No, I was able to buzz Kim, and I think she might be climbing on the roof to take care of it.
You could throw your outline at them. Someday I'll learn how to advance the slides without scrolling. Sorry, everybody. Okay, this is the real sleeper in the law that's going to get a lot of money to a lot of your clients. It's the employee retention credit. And it was a very difficult credit to get in 2020 because you had to have more than a 50% drop in revenue for a calendar quarter, the second, third, or fourth quarter. And you had to not file a PPP loan application or you didn't get it. And then you could only get up to $5,000 per employee for the whole 3 quarters cumulative. Well, what's most important here is that you can now go back, and if you satisfied that 50% test for a calendar quarter, even if you got a PPP loan, you can now retroactively apply and get that credit. It's up to 50% of the compensation of employees, not more than $10,000 in compensation, and therefore not more than $5,000 per employee. You can go ahead and get it back, Jack, unless you used all those wages for forgiveness in the PPP application. And Brandon, can you amend the PPP application?
Yeah, as long as you haven't received actual forgiveness yet, then you can amend a pending application. So if you have a pending application out there that was all 100% payroll costs, and you had a borrower that had a more than 50% drop in gross receipts, contact the bank right now and get that application back before the SBA approves it and issues your forgiveness amount, because you're going to want to adjust some of the figures on there to spend less on payroll, more on non-payroll. That way you have more wages eligible for the retention credit.
So since you have to spend 60% on payroll, and though that's this, for the most part, the same payroll that applies under this credit, you run a spreadsheet as to quarter by quarter, what payroll do you need for the credit? What payroll do you need for the PPP? And how are you going to allocate it? It's going to be like a two-tiered spreadsheet. Now, for your convenience, anything yellow here is for 2020, and anything blue is for 2021. And we've run these slides yellow for March 12 through December 31st, 2020, and blue for the first 2 quarters of 2021, because that's only as long as it lasts as now existing. And on page 225, remember, you can now take this in addition to the PPP loan retroactively. So it's one heck of a nice situation. Now, even if you don't qualify for the calendar quarter reduction, you can get the credit to the extent of the days that your business was fully or partially suspended due to orders from a governmental authority limiting commerce. So if you're a restaurant and you had to go to checkout to takeout, and you were still paying employees who had to stay home because you didn't need servers, you didn't need bus people anymore, then you can get the money back for that. And Brandon, what are the exceptions to this?
Yeah, so I think the important part to mention is that for as long as it's fully or partially suspended test, it's only the days that you were fully or partially suspended. It's not the entire quarter if you had one day. If you just had 10 days in the quarter, only those 10 days would count. If you were qualified under the gross receipts test where you had a 50% reduction, then you can count the entire quarter. So I think the first step is to see if we had that 50% drop and we qualify for the whole quarter. The second is what days were we fully or partially suspended. The important part here is just partially suspended too. If you had, as Alan mentioned, you're a restaurant and you couldn't serve people inside, you were limited to just outside service or takeout, then that's a partial suspension of your business, and that qualifies you for the credit. So I think a lot of businesses can qualify under that partial suspension test. Now, if you were a law firm and you could work just as well in office as you can telecommuting, even though the office was shut down and all your employees are telecommuting, that's not going to be a partial suspension of the business. It has to be something a little bit more than just we're forced to work from home. It needs to be an actual shutdown, something that you couldn't do in the business to qualify under this test. Now,
what about healthcare costs?
Yeah, so initially there was some confusion as to whether you could count healthcare costs as wages. It's clear now that you can count those as wages, and it's even better because they count as wages even if you aren't paying the employee anything else. So a lot of businesses did furlough employees so they could get unemployment, which would generally, in some circumstances, maybe even pay them more than what the business could pay them, but still kept them on their healthcare plan and continued to pay for healthcare expenses so they could have coverage. In that situation, those healthcare costs can count as eligible for the credit, even though you're not paying an employee a wage. That applies for both 2020 and 2021. For 2020, again, it's that 50% test. You're comparing 2020 quarters to 2019 quarters. It has to be the same quarter. If you drop below 50, then you qualify, and you continue to qualify for each quarter until you get to a quarter where you have 80% of the receipts that you did in 2019. We'll go through some examples of how those tests work, but you qualify up until that end of the quarter where you cross that 80% threshold. For 2021, it's an 80% test, so you only need to have a 20% drop in gross receipts for 2021. And we're comparing all the way back to 2019, not just 2020. Most businesses had a higher gross receipts in 2019 than they did in 2020, so that's helpful. And it's simply a 20% drop to determine if you qualify. You can also look at the prior quarter. So if we're in quarter one, we can take a look at quarter four of 2020 compared to quarter four of 2019, the prior quarter of the current quarter, in order to see if we qualify. And we'll go through some examples as to how it works for 2021 as well. Another important point here is on the next slide. How does the number of full-time equivalent employees impact the availability of the credit? Well, there's two situations where this is impactful. Number one, if you had more than 100 employees, you will only get the credit to the extent you're paying those employees to stay at home and not provide any services to the business. So if they were telecommuting 1 hour, then that doesn't qualify towards the credit. The good news is in 2021, that 100 employee limit is increased to 500 for purposes of qualifying the wages for someone that's not providing any services. If you have under 100 employees, then it doesn't matter what that employee's doing. If you're paying them to work in the office, if you're paying them to work at home, you get the credit for the amount of wages that you paid for them. The second circumstance for this to matter is as far as increasing wages. If you had over 100 employees in 2020, you only get a credit to the extent that you are paying that employee an equivalent amount of wages for the prior 30 days. So we're looking at past compensation, determine if we increase someone. If we have over 100 employees, we don't get credit towards that increase. In 2021, that rule is gone. It doesn't matter. You can pay a bonus to an employee, you can increase their salary and maximize this credit without any penalty. The time periods, it's $10,000 for the year for 2020. That's $5,000 of credit per employee for the entire year. In 2021, that limitation is 70% of the wages, so $7,000 per employee, and it's per quarter. So you can get this in both quarter one and quarter two. Again, you can't double count PPP loan forgiveness and the wages. We've talked about that. And then finally, the last point here on the slide, if you had less than 500 employees, you can file a Form 7200 and request an advance on this credit. You get the advance based upon 70% of your wages in 2019, again, subject to the $10,000 limitation, but you can get an advance cash payment up front now. And then you reconcile this on your payroll tax return, whether you owe a little bit more back or you should get a little bit of an excess. So keep that in mind as far as advancing this loan amount. We have information on how you claim this. If you're going retroactive, you file an amended payroll tax return to claim the credit. If you're requesting the advance, it's the Form 7200. What wages qualify? Can you, if you're an S corporation or a C corporation and you're paying wages to the owner, that qualifies. If you're a self-employed individual, such as a partner in a partnership or a sole proprietorship, self-employment income is not eligible for the credit. What about wages to the owner's spouse? We think those qualify as well. The limitations do not apply and do not mention spouses as a related party, even though there are other related parties that wages paid to them do not qualify. So if you had a child, a brother, a sister, an in-law, daughter-in-law, son-in-law, father-in-law, mother-in-law on the payroll and you're paying them wages, even if they've been employed for the entire life working for the business, those wages do not count. The related party rules disqualify the payment of those wages. That's issued by the IRS in the form of a frequently asked question. As you notice here, all these individuals are considered related. It's related to more than a 50% owner. So if you have no owner with more than 50%, you don't have to worry about these rules. But if you have someone that's over 50%, you have to look at related party wages to see if they qualify. Again, notably, there's no limitation on wages to spouses, and then there's no limitation on wages paid directly to the owner, other than the caps on the maximum amount that can count. Here's the language from the actual statute. We tried to redline this so you can match up what happens in 2020 versus 2021. We have the frequently asked questions from the service on the slides as well as slides to help you determine your testing periods, what quarters you're comparing, what happens if you're not in business in 2019, what quarters do you look at. So now to go through some examples here of how this works. First is the examples to determine eligibility. Again, we look at gross receipts compared from 2019 quarters to 2020 quarters. We have to compare the same quarters. So in the second quarter, we first qualify because we get below a 50% reduction from receipts in the previous quarter. So that is an eligible quarter. In quarter three, we're still below 50%, so we're still qualifying. In quarter four, we cross that 80% threshold. So this is our last quarter to qualify, but we qualify through the end of this quarter four. Another example here, we first drop below 50% in quarter two. We cross the 80% barrier in quarter three, so we continue to qualify through the end of quarter three, but we don't qualify in quarter four. Now, if quarter four drops back below 50%, so let's say you had $100,000 of receipts in 2020 in quarter four, then we think you're starting to qualify again. So it's a retesting once you cross the 80% threshold. If you drop back below 50% the next quarter, then you can go ahead and qualify again for the credit. In 2021, the test is slightly different. Again, it's only a 20% reduction to meet the threshold. So we qualify in the first quarter here by having a 20% reduction. We also qualify in the second quarter, even though we don't have a reduction in that quarter, because we can use the prior quarter. We look back at quarter one, we qualified there. So these are considered to be eligible quarters. Now, what wages count? If we have 3 employees, one makes $15,000 a quarter, one makes $7,000 a quarter, and the other makes $3,000 a quarter, then in 2020, for employee A making $15,000 a quarter, we only can count $10,000 for quarter two, quarter three, and quarter four. It's per year limitation. Employee B, we can count $7,000 in quarter two and $3,000 in quarter three once we hit the max of 10. C doesn't reach the max, so we can count all wages paid to C. We add all these up, we multiply by 50%, and we get our potential credit amount of $14,500. So we can see here how it gets much better in 2021. We can count all wages, or 10,000 of wages in each quarter for employee A, all wages to B and C. Again, we add these up. Only 2 quarters in 2021 compared to the 3 of the prior year, but we get a credit that's almost double the amount that we got in 2020 of $28,000 here, because we can count wages in both quarters and because we have a higher percentage of wages that qualify towards the credit. So you can see here the benefit of the retention credit. It's going to be very important to analyze what's going to count towards PPP loan forgiveness, what's going to count towards this credit, if we do qualify by having a drop in gross receipts. So don't forget about this when we're filling out loan application. It's going to be very important to make sure we are planning for and doing this the right way. A couple of other things to mention. There are aggregation rules for determining, number one, whether you have over 100 employees, whether you meet the gross receipts test, and whether you're fully or partially suspended. So don't forget about adding in your affiliated companies. The affiliation rules under 414M related to affiliated service groups are the tests that are used to determine if you have an affiliated entity. We have guidance here on whether you're considered to be partially suspended, whether you're actually fully shut down, what types of examples can apply to consider an operation fully or partially suspended. It's all very well written. Gross receipts test, a little bit different than the gross receipts test that applies for PPP loan testing. We have the guidance here from the frequently asked questions as well. We also have the guidance for what's considered to be a gross receipt by a tax exempt employer. So this is all here. A lot of these might be a little bit out of date because they were written back in June and July before the Economic Aid Act was passed. So they need to be updated for that. But for the most part, I would say 80% of them are still going to be worthwhile reading, and they're still up to date from the previous act. Just keep in mind that they might change slightly.
Brandon, what about S corporation shareholders who take dividends? Do they get any wage credit for dividends they've been taking?
It's not going to be a credit for the dividends. You get a credit for the actual wages paid, the W-2 wages paid to the shareholder, not the dividends.
And is there anything in here for a Schedule C taxpayer?
Yeah, there's nothing in, no benefits for a Schedule C taxpayer individually. Now, if they do have employees and are paying employee wages, you could claim a credit for those employee wages. But unfortunately, there's no deemed of like self-employment income for the Schedule C is not going to be considered a wage eligible for the credit.
if the company paid the shareholder 50,000 a year in wages and 300 in dividends in 2020, can they bring the wage up to 10,000 a month in 2021?
Yeah, they can in 2021. They wouldn't be able to increase. Well, obviously now you can't increase 2020 wages retroactively, but the wage increase rule would have prevented them from increasing their wage in 2020 to maximize the credit, but it would not prevent them in 2021 to increase their wage to maximize the credit.
Okay. Okay. Very good. So I'm going back now to page 216 to talk about the grants for shuttered venues. And the statute is pretty clear here. You have to be an eligible person or entity, a live venue operator or promoter, a theatrical producer, a live performing arts organization operator, a museum operator, a motion picture theater operator, or a talent representative that meets the following requirements. One, was fully operational as a live venue operator or whatever they were doing on February 29, 2020. And two, has gross earned revenue during the first, second, third, or only with respect to an application filed on or after January 1st, 2021, which is going to be all of them, the fourth quarter of 2020, that demonstrates not less than a 25% reduction from the gross earned revenue. Excuse me for reading this, but this is what it specifically says. So if you are one of these organizations and had less than a 25% reduction of the gross earned revenue, then you get the grant. And the grant is lesser. It cannot exceed $10 million. And in general, it's going to be 45% of the gross earned revenue for 2019. That's going to be a pretty big check. Now, what can the money be used for? Payroll costs, payments on covered rent obligations, utility payments, and then pre-existing debt, scheduled payments on interest or principal under a mortgage obligation, not including any prepayment, or scheduled payments of interest and principal on indebtedness or debt instrument incurred in the ordinary course of business that was a liability before February 15, 2020. Covered workers protection expenditures and payments made to independent contractors as annual compensation up to $100,000 per annum, and for employees. So this is going forward money. The fact that these entities have been hemorrhaging and pulling on huge lines of credit does not allow them to repay those lines. They have to keep that pre-existing debt in place. Now, if they go into bankruptcy before they've spent it, it seems to me that there's no way to prevent it from taking care of the pre-existing debt. And I think a lot of these theaters and a lot of these companies will get the loan and then pay for some things for a period of time, and then possibly file bankruptcy and let all this debt that has been guaranteed by the officers and directors get paid. I'm not sure how that's going to work, and I would certainly consult with a bankruptcy lawyer before doing that. But it seems to me that that is what's going to happen in a lot of cases. So you can use the money for maintenance, administrative costs, state and local taxes, operating leases that were in effect on February 15, 2020, payments required for insurance, and then advertising, production, transportation, capital expenditures relating to producing a particular theatrical or live performing arts production, concert, expedition, or comedy show. Except that a grant under this section may not be used primarily for such expenditures. So primarily, maybe that means over 50%. Maybe that means a lot less than 50%. The word primarily is the subject of hundreds and hundreds of court and tax cases. So that's going to be an interesting situation. What is absolutely prohibited? You can't use it to buy real estate. You can't use it to make payments of interest or principal on loans that came into existence after February 15, 2020. They don't really mention refinancing. I hope that they will accept that refinancing is not a new loan. Can't use it to invest or relend funds to anyone else. Can't use it in political activities. And then there will be another list that we'll probably get from the SBA of other things that you cannot use it for. So, and you are not eligible if you receive certain other assistance. As you can look at this slide, page 221. If you've received certain other assistance from the SBA, then you can't receive that. So that is the shuttered venue grant. Brandon, is there anything else you want to cover before we take a look at a couple of questions? We've got about 4 minutes, also known as 3/10 of a billable hour to many of the attendees.
Yeah, I think we've covered, the highlights. I think we take some questions to the extent we have them here and close us out.
Okay, first one's from Robert. On slide 247, question 85, does this say you can't get a deduction for the wages you use to qualify for the ERC?
No, you can't get a deduction to the extent you receive the credit. So you're counting $10,000 of wages, you're getting a credit towards 5,000 of those, so you can't count the $5,000 of wages as a deduction. The other 5 can count.
Okay, very good. This one's from Brendan. If an entity uses a fiscal year end like June 30 rather than a calendar year and doesn't maintain sufficient records to calculate receipts on a quarterly basis, is there a way it can prove a 25% reduction under the provisions of the 1/6 interim final rule? The only thing I can think of would be to compare receipts on tax return 2019 versus tax return 2020, right?
Yeah, and I thinking about that might allow you to use your fiscal year, because if your tax return's filed on the fiscal year basis, it says you can use your tax return receipts for 2020 versus 2019. So
okay.
Otherwise, you're stuck with calendar years.
Yeah. Okay. That's a good question. Okay, Bruce, if you only need 15 weeks to use up the PPP loan, can you end it at 15 weeks, but will the FTE requirement end at the end of week 15, or do you need to meet the FTE requirements for 24 weeks? That's a really good question.
Yeah, and it actually does end at 15, and that's the benefit, another benefit of allowing us now to select the end of our covered period. We don't even have to spend the full loan amount. If you are at 15 weeks and you realize that you're going to have to lay off half of your staff for some reason or the other, you could end your covered period at that 15 weeks and no longer have to worry about the retention of your full-time equivalent employees. You might have to pay back a portion of the loan because you haven't spent it all, but you would not be reduced forgiveness for reducing employees after that end of your covered period date.
Okay, here's one from Andrea. She says, I use 139, and can we still use 139 for 2021? She says, thanks again for presenting. The information you are providing is so excellent. Okay, I agree with the second part.
I think you can continue to use it. Applies as long as we have a continuing disaster declaration for the coronavirus. So I don't think that's scheduled to end, but that would be the check, and I am pretty sure it would continue through probably into the first quarter, presumably at least, if not longer.
Okay, and I will end it with Ruth here. Thank you for your question, Ruth. Do seasonal businesses compute the gross receipts for second draw differently?
I don't think so. I think they're still looking at the quarter by quarter analysis, focused on the quarter where you are in season.
Okay. Very good. Well, we have really enjoyed providing this presentation for you and putting it together. We will continue to update our materials and keep you posted. If you have any questions, comments, or suggestions, we always appreciate them. You've got our email addresses down there. As I always say, send Brandon the hard ones, send me the easy ones. Thanks for supporting your society and your charitable organization. I hope that I can write a lot of $25 checks for a lot of scholarship for people who really are in need and whose lives can be helped by your program. So Keenan, back to you.
All right, folks, we are clear.
All right.
Okay, thanks very much.
Very much.
Awesome. Good stuff as always, guys.
All right. Have a great day. Take
You
care.
too. Have a good weekend.
You too. Bye.